Man, what an exciting week in the markets. Bitcoin is still sitting at exactly the same level, minus these large deviations up and not so big of a deviation down. This is actually incredible. We're going to be covering a lot today. I'm going to be cutting over to catch Jerome Powell speaking live here in a matter of a couple minutes, but we're going to run through some stuff real quick before we get there. What do we got right now? We got a green on the 1 hour chart across the board. Look at this. Everything but PAX G. Everything and Zao T, whatever. We are looking green on the charts, but on the daily too, looking. So it's not as bad as it feels. We're almost feeling like that blood in the altcoin market may be coming to a bit of a low. And what I'm seeing is, look at this. Aerodrome came right down into a known level of support. I actually added to my Aerodrome position today. I dropped $1,000 in the market. Market bought right here in this zone. I don't really care if this drops because my average entry from all the different buys we've done throughout here, average entry is up here in this range up here. So, adding $1,000 and lowering my average entry because I have conviction. Ask yourself in your portfolio, what do you have conviction on? If you really believe in it, if you're holding at this level, then that means you would be willing to buy at this level. If you have extra capital, think about what assets you're looking at and, in terms of where you want to stack into this market. When we come over here and we look at this, let's go ahead and refresh this page very quickly here. We're sitting here at 2.68 trillion. Not much has happened, but the most important thing is what are we starting to get? We're starting to see pressures in the market. The question now is, are we going to get a rate cut in May instead of June? Like it was so predicted. We see Bill Ramsey here. Happy Friday, my guy. Let's get it. Shout out to you. Got Crypto Billy in the house. Givers Gain. Shout out to that whole team there. Renegade Designers. How you doing? Crimson. How you doing? That wouldn't happen to be Crimson Caravan. Did you change your name? Let me know. Uncle Tommy, how you doing? We got the whole token tide temptress. We're going to be hanging tough here today because look at what Trump said. This would be a perfect time for Fed Chairman Jerome Powell to cut interest rates. It's almost as if, let me see where this is. It's almost as if Trump did not make this, but Trump reposted this on his page. Now, I don't agree with the comment from Warren Buffett. It's kind of been disproven that Warren Buffett said this, but this outlines the same thing that I've been talking about here, that maybe this was all part of the same plan. And the reason why I say that is because Trump reposted this on his account on Truth Social. Let's take a listen real quick.
Trillions of debt very inexpensively. It also weakens the dollar, and Trump is crashing the stock market by 20% this month, but he's doing it on purpose. And this is why Warren Buffett just said Trump is making the best economic moves he's seen in over 50 years. Now, here's the secret game he's playing, and it could make you rich. So why is he doing this? To push cash into treasuries, which forces the Fed to slash interest rates in May, and those lower rates give the Fed the ability to refinance trillions of debt very inexpensively. It also weakens the dollar and drops mortgage rates. Now, it's a wild chess move, but it's working. Now, you're probably wondering, what about his tariffs? Well, I'll tell you, it's a genius play. It actually forces companies to build here to dodge them. It also forces farmers to sell more of their products here in the US to bring grocery prices way down. We've already seen this with eggs. Now, remember, 94% of all stocks are owned only by 8% of Americans. So Trump, he's taking from the rich short term and handing it to the middle class through lower prices.
It's almost exactly the opposite of what people are claiming, that they're just absolutely against Trump. Now, to be fair, I just want to point out, somebody came at me last night talking about all the right-wing stuff I'm posting. I am not right-wing. I am in the middle of the pack, okay? There's so many Democrats in this administration. Think about that. Tulsi Gabbard, Elon Musk, Donald Trump originally was Democratic. A Democrat. We have Robert F. Kennedy. The reason is if you are center now, you are right. And I don't mean like you are correct, which I actually think you are, but my opinion doesn't matter. What we're looking at right now is what has been outlined has needed to happen from people that are on the left, from Nancy Pelosi and Chuck Schumer and President Obama and Bill Clinton and Hillary Clinton, all of them stating that this is the necessary path for the American people. over the last many years. And somehow now you are an asshole if you're doing it, if Trump suggested it and is actually acting on what has been talked about on a bipartisan level. This is not a political show. We're talking about markets. We're talking about assets. We're talking about being better ourselves and realizing, hey, if I disagree with you and you disagree with me, let's share some facts that you've gotten and facts that I've gotten, because we're all some reason, some way getting presented different facts. Well, let's come together because we're probably both a little bit wrong or we're probably both a little bit right. The question right now is we're changing the status quo of how things have been being done, and it makes it ruffles feathers. But let's let this play out because we're coming right into a time where we have $9 trillion that we need to refinance in the coming months and over the course of this year that we cannot do at the current federal funds rate. It kind of makes a little bit more sense when you understand that we need the market to go down. We're seeing the unemployment numbers go up, which is bad, but it's all these things are actually great for getting us in a position to where we can talk about Fed interest rate cuts, which is going to make money cheaper, which is going to start the flow of money, which is going to get us into that scenario where we actually see markets boom. If we're not focused on the minute today, right now, the market is down. Sometimes if you're racing a car, if you ever watch any Formula One or NASCAR, they have to pull over into a pit stop. Now, of course, they're not going as fast when they're in the pit stop, but it does mean that they can go faster and longer once they get out with fresh tires and new fuel in the car, fresh set of fuel. This is where we're at right now in the economy. We're doing a little bit of a reset, so let's let it see how it plays out. Now, do we have him talking yet? He's not talking yet, I don't think. I'll just leave the volume on here in case he does pop up, but I got this primed up. You guys let me know. If you do see it going live anywhere else, you let me know. And send me the link and I will pull it up. When does Powell start chatting? I don't know. We got it primed, baby. But we're going to be listening to this. We're going to be going through some charts. I'm going to actually put this right here so I can see it. That way it's not on the screen there. Boom. It says it's supposed to be at 11:25, which is now. And you can see that right here. Powell speaks 11:25. So hopefully that comes on soon. You guys let me know if it is somewhere else and I will switch over. But looking at this, he's talking about, it's almost, why would he say this unless some of the things he's done has put the pressures where they need to be to get, the Fed can't just cut. If the market's running away and inflation's still running away, no, inflation's starting to come back in line. We've seen over the last several months. We're seeing unemployment numbers go up, which is not good. It means things are starting to break. And it's also, hey, he's kind of a little bit behind the ball here. But then we continue on and we see we're at extreme fear. What do we do during extreme fear, everybody? We buy when there's blood in the streets. So we've gotten a lot of the signals that I like to see when I want to buy. When everybody's scared, we're starting to see Bitcoin is holding up better than the stock market. Bitcoin bottoms first, which was what we've seen. Matthew Hyland has outlined here on a number of times here on the stream. And then we see, look at this, U.S. Standard Chartered Bank think we could see Bitcoin pump to an $88,000 price this weekend as it has become the U.S. isolation hedge. Banks are now talking about Bitcoin being a hedge. Are you not bullish here? What are you thinking? And yeah, we're seeing, oh my God, massive drops in the price action. We also saw Bitcoin today drop $2,000 when China talked about a reciprocal tariff. However, we're starting to see people come to the tables. This is that unemployment number that we talked about. This is great. This is great for that Fed impetus. And look at this, U.S. employment rate rising at 4.2, higher than expectations, generally increases the likelihood of Federal Reserve interest rate cuts. This is what we want to see. And then here we go. We're starting to see it right here. We're starting this drop from 90% down to 62% because no longer do people think it's just going to be a pause. We're starting to see that oscillation. Oh, here we go. It's okay. I can see he's not talking yet. I'll pull it up right when he starts talking. But this is in line with them getting towards, maybe it's not a pause, maybe it's a cut. Now it's not a huge number yet, but we're getting strong. We're getting signals in line that 100% opportunity or likelihood of a cut in June. Now it's starting to warm up to maybe not a cut or a pause in May, but maybe a cut. And this is what we just watched this. But then this is what I was talking about. People coming back to the table to negotiate. What do we see? Vietnam now wants to cut their tariffs down to 0. It's almost as if he's doing things that they've thought through because we are the number one consumer to bring things in line. And if we start getting a reversal or a reduction because we're getting people, different countries coming to the negotiation table, it gives us much stronger case for a reversal of that we've never seen before. And if everything's coming in line right now to actually have a reversal, a bottoming of the stock market, a bottoming of crypto, which will likely happen in Bitcoin before the stock market. And now we no longer have all the headwinds we've had over the last 14 years for the crypto market, but now all those headwinds are tailwinds and people are bearish here. We have the most bullish asymmetrical opportunity in the Bitcoin market in history. Altcoins, there's going to be some incredible winners, but not all. This is going to be an interesting cycle, but the buying opportunity is right now because the entire paradigm just shifted in favor of the bullish narrative long-term outlook. There's no reason to be bearish here unless you're looking at a 15-minute chart. Then I say, I bid you, a lot of strength for the stress you're going to deal with in the coming weeks and months. But the long-term plays here, the opportunity here, the asymmetric opportunity is now. You buy when you're most scared to. Now, this is not financial. This is not financial advice. This is just strategy. Oh, he is speaking. Okay, let's see.
Or role to comment on those policies. Rather, we make an assessment of their likely effects, observe the behavior of the economy, and set monetary.
Let's go back just a little bit. I'll put them on 2x speed.
And businesses report dimming expectations and higher uncertainty about the outlook. Survey respondents point to the effects of the new federal policies, especially related to trade. We are closely watching this tension between the hard and the soft data. As the new policies and their likely economic effects become clearer, we will have a better sense of their implications for the economy and for monetary policy. Looking across many indicators, the labor market appears to be broadly in balance and not a significant source of inflationary pressure. This morning's jobs report showed the unemployment rate at 4.2% in March, still in the low range where it has held since early last year. Over the first quarter, payrolls grew by an average of 150,000 jobs per month. The combination of low layoffs, moderating job growth, and slowing labor force growth has kept the unemployment rate broadly stable. Turning to the other leg of our dual mandate, inflation has declined sharply from its pandemic highs of mid-2022. It has done so without the kind of painful rise in unemployment that has often accompanied periods of tight monetary policy that are needed to reduce inflation. More recently, progress toward our 2% inflation objective has slowed. Total PCE prices rose 2.5% over the 12 months ending in February. Core PCE prices, which exclude the volatile food and energy categories, rose 2.8%. Looking ahead, higher tariffs will be working their way through our economy and are likely to raise inflation in coming quarters. Reflecting this, both survey and market-based measures of near-term inflation expectations have moved up. By most measures, longer-term inflation expectations, those beyond just the next few years, remain well-anchored and consistent with our 2% inflation goal. We remain committed to returning inflation sustainably to our 2% objective. Turning to monetary policy, we face a highly uncertain outlook with elevated risks of both higher unemployment and higher inflation. The new administration is in the process of implementing substantial policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. Our monetary policy stance is well positioned to deal with the risks and uncertainties we face as we gain a better understanding of the policy changes and their likely effects on the economy. It is not our role to comment on those policies. Rather, we make an assessment of their likely effects, observe the behavior of the economy, and set monetary policy in a way that best achieves our dual mandate goals. We have stressed that it will be very difficult to assess the likely economic effects of higher tariffs until there is greater certainty about the details, such as what will be tariffed, at what level, and for what duration, and the extent of any retaliation from our trading partners. While uncertainty remains elevated, it is now becoming clear that tariff increases will be significantly larger than expected. And the same is likely to be true of the economic effects, which will include higher inflation and slower growth. The size and duration of these effects remains uncertain. While tariffs are highly likely to generate at least a temporary rise in inflation, it's also possible that the effects could be more persistent. Avoiding that outcome would depend on keeping longer-term inflation expectations well anchored, on the size of the effects, and on how long it takes for them to pass through fully to prices. Our obligation is to keep longer-term inflation expectations well anchored and to make certain that a one-time increase in the price level does not become an ongoing inflation problem. We'll continue to carefully monitor the incoming data, the evolving outlook, and the balance of risks. We're well positioned to wait for greater clarity before considering any adjustments to our policy stance. It is too soon to say what will be the appropriate path for monetary policy. We understand the benefits of a solid economy where workers can find jobs and inflation is low and predictable. We also understand that elevated levels of unemployment or inflation can be damaging and painful for communities, families, and businesses. That is why we at the Fed will continue to do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Let's hear these questions.
Most importantly, thank you for being here. This feels like quite a moment to be speaking with you, and I want to thank you for your time. He's got it. I want to thank you for being here, and thank you for taking the time to speak with this group of business journalists. Also like to give a special thanks to Heather Long with the Washington Post, who helped make this event possible. So for starters, sir, how's your week been?
Just fine, thank you.
Care to elaborate?
So far, so good.
Chair Powell, yes, thank you so much for being here and taking our questions. You were talking about the economy as being a very strong economy. You characterized inflation as coming down, employment as being very strong still. However, President Trump, earlier this week when asked about the market volatility we've been seeing, said the volatility was, quote, to be expected. This is a patient that was very sick. We inherited a terrible economy. A lot of voters did and do agree with that assessment, or at least in part. I'm wondering how you would respond to that assessment and the disconnect between the story of the data and the way a lot of people are feeling about the economy.
Sure. So let me just be clear at the start. I make it a practice not to respond to any elected officials' comments, so I don't want to be seen to be doing that. It's just not appropriate for me. But the situation, I think, is this, and people, when they're surveyed, they are unhappy about the economy. That seems to largely reflect the increase in the price level that happened when inflation was high, 2021, 22, and 23 largely. Inflation is now back down to much more normal levels. Unemployment is low. The economy has been growing, but people are still experiencing that high price level. In other words, prices don't go down. They know they're paying much more for the basic necessities of life, and they're right that they are, and they're not happy about it, and they're right not to be happy about it. So I think that accounts for the negative sentiment. Of course, we're looking at inflation, which is the change in prices, and we're seeing that has come down quite a bit, and that unemployment is actually low. It's sort of very close to measures of maximum employment, and the economy's growing. So all those statistics are good, but the price increases of the past few years are weighing on people's budgets.
So I'm from Milwaukee, and I've been talking to business leaders, executives, and consumers in our community, in our region, for the last few weeks, mostly before this week's news. Gentlemen, they're troubled and they're nervous. One business owner told me, if there's a hint of a recession, we're cooked. And he asked me to share that with you. What's your response?
So I guess I would say, let's start with the fact that the incoming data right through this morning's employment report, which admittedly is from roughly a month ago, the week of March 12, they took the data in, it still shows a solid economy. Unemployment's still low. I understand the uncertainty that's weighing on people. You ask about a recession. We don't make a probability forecast of how likely it is for there to be a recession, but many outside forecasters do, and many of them have raised the likelihood, albeit from very low levels. It's not something that anybody now is forecasting, or some people are starting to. So there's not much more I can say about that. I realize that the uncertainty is high, and what we've learned is that the tariffs are higher than anticipated, higher than almost all forecasters predicted. We still don't know where that comes to rest, though, and we're just going to have to see that through.
At a congressional hearing last year, one of the U.S. representatives said that you were pretty boring, and you thanked him and said that you considered that a very high compliment. And in fact, I feel like it's one of the roles of the Federal Reserve, especially since the housing crisis, to be kind of a ballast, especially in the face of the volatility of the markets and the dramatics that we can experience with the economy. Very steady, no surprises, very reliable. In a moment like this, which also has a lot of drama and unpredictability, but it is not necessarily from an economic crisis, it's by design, it's political. How do you see your role in this moment?
So I think all of the values that you touched on are, in fact, the values that we try to live by. We're driven by, analysis and careful thought and discussion and debate, and the merits of things. We try to stay as far as we can from the political process. We don't look at political cycles or things like that. And I think people expect that from us. They expect us to tell the truth, and that's what we're going to do. But at the same time, we don't want to be part of the broader political discussion about the wisdom of policies that are not assigned to us. We're not responsible for trade policy, immigration policy, fiscal policy. So we don't comment on those. Decisions are made by others, and what we do is we use our tools to try to achieve the goals that Congress assigned us, which is maximum employment and price stability. So I like to think that over time we're a source of calm, rational analysis and also of stability. That's really what the business that we're in is providing, financial and macroeconomic stability to the public. That's really our purpose.
So how can businesses and individuals and the Fed make plans for the future when so much is being dictated by the actions of a single person? And do you see yourself as the consoler-in-chief on economic matters?
No, I think, take a step back. What's happening is, as I mentioned, the new administration is making, significant policy changes in trade, immigration, fiscal policy, and regulation. And you're still just a couple of months into the administration, and that process will take place. And at a certain point, the new policies will be on the table. They will be having the effects they're going to have on the economy, and uncertainty will decline. Right now, there's a lot of uncertainty about where all that's going to sort out, the forms it will take, and what the economic effects will be. If you fast forward a year from now, the uncertainty should be much lower. The actual effects of the policies should then be pretty manifest and clear. So I think I understand why it just is highly uncertain, both what the policies will turn out to be, exactly what they'll turn out to be, and also what their effects will be in the near term. We just have to go through that process, and it is just kind of a manifestation of our election cycle and a new administration coming in with new policies.
I mean, given all of the change happening and the fact that we are in a period where things have not settled in yet, and that the Federal Reserve and you as chair are very projection, data-driven, policy-driven, how do you handle a moment like now? I mean, can you tweak your plans and projections? Do you just do you have to reset them?
So, what we've had since in the last few months is, from the staff, has been a placeholder. Rather, they wouldn't call it a forecast because it's so uncertain. They call it a placeholder. And that's kind of how we've been thinking about it. So it's a good time to take a step back and let things clarify. That's why it's just too soon to say what the appropriate monetary policy response will be to these new policies. It is just too soon to say. We can't say with any confidence today. So that's what we're doing. We've taken a step back, and we're watching to see what the policies turn out to be and the ways in which they will affect the economy, and then we'll be able to act. Fortunately, our policy stance is in a good place for us to do that. We're probably moderately restrictive, let's say, so it's not really tight policy, but which is appropriate since inflation is a bit above target. So we think we're well positioned to address whatever may come. And in the meantime, I'd say we're waiting for greater clarity before we consider adjustments.
Business owners in Wisconsin have told me that they can't make their plans. They want to expand. They want to build a new facility. They want to hire or do whatever the future calls for. They say, we're trying to look around the corner. We're not even sure where the corner is, and we're not even sure what's around the corner. Sounds like they're in the same position as you are a little bit.
No, we hear the same thing. Of course, we have an incredible network of contacts with businesses and also universities, nonprofits, all different sectors, through the reserve banks and also through the Board of Governors. And that's what we hear. But again, it's a process. We're going through it, and I think we will know when we know what the policies are exactly and what their implications will be for the economy. That will all become clear, and I think that'll be a time when people can make decisions. In the meantime, though, I get it. We're hearing that a lot from people, and we are kind of in the same place, which is waiting for clarity about what our policy path should be.
We're tired of waiting. Throw one in chat if you're
We'll have
tired
to
of
see.
waiting. I'm ready for the green rockets, man. Golly.
As you're talking about placeholders right now and having something in the place when there's so much that we don't know, it does occur to me that this is not the first economic shock that you have steered the markets and the economy through. Obviously, there was COVID almost exactly 5 years ago. It seems similar in certain ways with a lot of uncertainty, a lot of shock, also potential disruptions to prices and to supply, which is very much in the Federal Reserve's wheelhouse. I mean, from where you sit, can Liberation Day be compared to kind of the economic effects of COVID? Are they totally different, somewhat related?
I think each situation is different. There was COVID. There was also then, in the response to COVID, then there was high inflation, and then there was soft landing, and now we have new administration and changes in policies. And every situation, it kind of rhymes, but it's not exactly the same thing. And so in this situation, what we face is what I mentioned in my remarks is you actually have risks for higher unemployment and higher inflation, and that's difficult for a central bank because our tools, which consist of interest rates, either slow down or speed up the economy over time. And higher unemployment would call for speeding up the economy, and higher inflation would call for slowing it down. So you can be in a situation, if we find ourselves in that situation, we look at how far each of the two variables is from its goal, and we ask ourselves, how long would it take to get back? And we weigh those things and make a decision about what to do. But there's no question that's a different situation, very difficult situation. When we faced high inflation, it was painful for the country, painful for the people that we serve, but we knew what policy needed to be. We knew we needed to raise rates quite a bit. During the pandemic, we knew what we needed to do. It was very clear the direction that we needed to take with force, and we did.
It's almost a situation potentially where the dual mandate is at odds with itself.
The two goals are, as we say, in tension, or they may be. I'd say that's not what we're seeing right now, but it's the effects at the margin right now would be for higher inflation and perhaps higher unemployment, but that's a marginal effect. I would say you're not in a situation like we were in the 1970s where the two goals were really both pulling in opposite directions and required. It's just very hard for a central bank to be the answer to a situation like that. But that's not the situation we're really in today.
One of the questions from the audience that we had is, if unemployment takes off and inflation takes off, which lever do you go for? Which lever do you, what do you do?
So we actually have we have a document called our consensus statement, or the longer version is Statement on Longer Run Goals and Monetary Policy Strategy. And the 6th paragraph of that actually contemplates when the two goals are in tension. And what it says is, think about how far each variable is from its goal, and think about how long it would take for each to get back. So in a way, it's an equation. You're comparing two quantities which each have two variables. And then you say, you look at that and you think, what do we need to do? And typically this doesn't happen very often, but if one of them is further away, then you would focus on that one. In the case of high inflation, they actually both pointed in the same direction. The labor market was overheated and inflation was very high. So both of those called for tight monetary policy. This could be different, but again, we're not actually facing that today.
That's
the
most bullish thing you said.
Inherent in your job, which is that you're looking at the macro economy, at the global economy really, and the U.S. places in it, but also the data you're looking at is very profoundly human, as Jim has been pointing out. Jobs, I think, and prices are probably the two most human pieces of data, and certainly in our day-to-day experience, probably the things that loom the largest. How do you reconcile those two things when you're looking at the data, like both the global markets and knowing that the data represents a lot of lives and jobs and egg prices and things like that?
So I think at the Fed, we always keep a focus on the people that we serve, and we know and are very conscious daily that the things that we do have a real effect on people's lives. We know that, and it really does focus the mind. And I think if you talk to people at the Fed, there's a very strong commitment to serving the public as well as we possibly can. Economic events are just very, very unpredictable at times, and there are shocks that you can't see coming. But nonetheless, our job is to, whatever happens, use our tools to bring the economy back to stability, back to price stability, back to maximum employment. And that's what we do. But you're right. We try to keep everybody in the room with us when we're thinking about what to do.
So in response to the last round of tariffs, Harley-Davidson, which is based in Milwaukee, moved some production to Thailand. Now the company might be whipsawed again by the new tariffs. It could be really devastating for sales, for employment, for the future of that company. But a lot of companies are in that same position. And what do you say to companies like Harley-Davidson and their workers?
So it just isn't, I really want to stick to our knitting. I mean, we have this great thing called our independence of monetary policy, and that's critical for us to be able to do our job. But for us to keep that independence, we need to not succumb to the temptation to want to be a player on issues that are not assigned to us. And trade policy is one of those. There are many, many issues that people love to try to pull us in on, almost every issue really. And we just need to stick to our knitting, not get pulled into those things. And so trade policy is a classic one. Energy policy is another. Climate change, immigration is not really, although all of those things have economic implications, and it gets argued that way. But if we
if we treated those as our job, the case for our independence would disappear. So I really can't comment on, I mean, we hear the same stories like that, but honestly, you know, the policymakers who are charged with that, they're probably hearing the same stories too, and they're reaching a judgment about what's in the best interest of the country in the long run. That's what they are doing, I guess, and that's, you know, so it's not for us to comment on that.
What happens inside the Fed at a moment like right now, when there's so much change and quite a bit of uncertainty, when you're watching things unfold? What does that look like, practically speaking? What are people doing inside the building?
So I'm very proud to work with the people I work with. I can tell you that in times like this, or times like the pandemic, where the global financial markets were shutting down, the global economy was shutting down, people step forward and they say, "We've got this." These are career people who were here for the global financial crisis. They've got 25 years, 35 years of experience with crises, and they step forward and it's just incredible what they can do and how good they are. It's a great honor to work with them. So right now isn't that situation. You know, we have the situation we have, so, you know, our trade people and our inflation people and our macroeconomists are all working hard to, you know, to kind of digest the news of this week and try to filter that into the forecast that they'll make. And policymakers are doing very much the same thing, and we're reading everything we can about what's happening and lots of outside analysis too. We don't have an FOMC meeting until May 6 and 7, so that's really a process that lasts several weeks, and we're not quite at that stage yet. But we're kind of thinking ahead to that and working through all of that. I will say though, you know, it feels like we don't need to be in a hurry. It feels like we have time
really?
to, yes,
No.
yes, it feels like we don't.
Hurry up.
No, I mean, it's like I said, you have inflation is going to be moving up and growth is going to be slowing, but it isn't really, to me, it's not clear at this time what the appropriate path for monetary policy will be. And we're going to need to wait and see how this plays out before we can start to make those adjustments.
Question from the audience. One of our Cebu members is, are you in contact with other central bankers in other countries at a time like this?
Yes, pretty frequently. Absolutely, I am. And the same was true during the other crises I've been through. Not only that, though, we do meet very regularly. You know, the IMF World Bank meetings here in Washington twice a year. We go to Basel multiple times a year to meet. That's all central bankers. And there are also G20 meetings, G7 meetings where the central bankers are there. So we're kind of regularly meeting and talking. And
All right, I feel
that,
like he's kind of said what he's going to say. This conversation is getting a little boring. We gotta move on and look at some other things that are going on in the charts. You know, we've got the data. You know, we did the 1125 talk. You know, when we're looking at what's going on in the markets, let's actually bring this back over here, and we're going to turn the other one off. Boom, like that. I mean, mixed signals, right? Just like everything we've seen in this market for the last couple weeks. Yes, almost a month. I mean, look at the price action. If you take off all the charts and lines, price action, look at this. This is just sideways price action all the way since back over here. You know, my birthday, March 9th, all the way across, just a little deviations up, a little deviations back down. Nothing really has changed. When we look at it in context of the broader picture, what do we see? We see price action still in this sort of falling formation. We also see it also in this chart here with a little bit more falling wedge with the deviation below, but we are still kind of just cooped up. The price action is cooped up in this area right in here. We're seeing the same thing on ETH. Basically, a bit of a rising wedge. We talked about this potentially being a bear flag. Currently, it did break to the downside with this rising channel, rising wedge formation, kind of sitting right in the zone of trying to hold on. We see the same thing on XRP, holding on in the same zone. Everything is kind of waiting because there's such a tailwind. There's such a tailwind of bullishness, of the hope that this tailwind is going to result in capital flowing into crypto. That's what we need to pay attention to right now. Let me say this on main screen. The price action on Bitcoin and altcoins is essentially sitting where it was about a month ago, with the deviation up, a deviation back down, everybody with the stock market falling and the crypto market actually holding up relatively well, especially Bitcoin. Why is this? Because everything that was a headwind has become a tailwind. The landscape of bullishness into the future is just keeping people in this like hodl mentality and stacking mentality. The weakest hands have been chopped out. We're trying to see how far this is going to go, if who's going to capitulate. But the bottom, there's no telling if it's going to be this week or all the way into June. But the opportunity based on the bullish outlook of what's coming with all of these tailwinds is leading people to hodl here and to find opportunities to stack into this. And I hope you're part of that cohort. I hope you're part of the I'm stacking for the future versus trading yourself out of opportunity because you're frustrated with this moment. I know I'm stacking. Let me know what you're doing in the live chat right now. It says buffering. I hope it's not buffering. Warning, this stream. Yeah, it should be all right. Let me know if you're still good. Let's get back into the other data that we want to look at because there's still a lot of other stuff going on. You know, we talked about the Vietnam thing. Who cares about that? But this is interesting. This is the Bitcoin versus the S&P 500, essentially. We've finally seen a 3D bullish cross. 3-day. That's 3D. This is a bullish cross on the MACD. Now, what is this? This is the price of Bitcoin weighed against the stock market, showing that this is actually holding up better. If this is pushing up here, it doesn't mean Bitcoin's going up. Understand this. This is Bitcoin against the stock market. If this is going up, it could mean they're both falling, but the S&P 500 is falling more than Bitcoin. So Bitcoin is holding, it's gaining in value against the stock market. This is incredible. This goes back to what we just talked about a moment ago with Standard & Chartered talking about Bitcoin is actually becoming a hedge against the U.S. isolation. The isolation has to do with what the tariff trade wars that are going on right now about us kind of saying, hey, we're pulling back a little bit. You know, there's pressure being put on the markets. We're getting into the scenario in which we can likely start seeing Fed rate cuts. But in addition to these potential rate cuts, what we're seeing is Bitcoin is starting to show signs. It doesn't mean it has flipped, but it's starting to show signs of an opportunity of Bitcoin becoming a hedge against what we're seeing here in the stock market. Now, this is great. Now, this doesn't mean this can't, look at this, sideways, pushed all the way back up to the top and then continued all the way back down. We may get something like that. It's going to depend on what's happening on the landscape geoeconomically. This is no longer Bitcoin just out there with these massive pumps and dumps, which it never has been. We've seen that it ties very tightly to what we're seeing with the global liquidity. Coming back over here, what do we see? Strength of the dollar. When it's up, Bitcoin down. When strength of the dollar goes down, Bitcoin up. So it's not just Bitcoin and altcoins in their own siloed in their own niche class. Let me come back over here. When we pull this up on the global liquidity chart, we also see that when global liquidity, let's go ahead and tack that. Look, global liquidity, the rate of change, that's what we're seeing here. The rate of change supercharged. We had the sideways action but then it ultimately got captured into the value of Bitcoin. Look at this, up on the global liquidity, ultimately got captured into the value of Bitcoin. Similarly, look at the rate of change of global liquidity. Basically, it's rounding out here, so no more fuel in the tank. This forewarned a drop over here. And then we actually see the global liquidity tick down. And what are we also seeing over that same time period? The down pressure on Bitcoin's price action. So it is still trading as a risk asset. But when we look back over to this, where is that at? This chart that we're just looking at, this is showing signs that it's kind of shifting that correlation that we were seeing with all direction is going to be very similar. This is actually showing Bitcoin is holding up better. Now, if you're only in alts, this is still very relevant to you because if Bitcoin does have a massive breakdown here, altcoins are going to get absolutely crushed. And there's no telling what's going to happen here, which is why I've just been periodically stacking when I feel, like when we were talking about today, when we're looking at Aerodrome, I stacked into this, the potential that Aerodrome may be incorporating some foreign exchange, basically trading monetary value between different currencies, which is a massive multi-trillion-dollar asset trading class. Well, if Aerodrome does process that, and it's on base, and we're seeing so much growth in the base ecosystem, this coming down to a known level of support, this descending level of support gives me indication I'm okay. If this drops further and comes down to 30, I'll be buying again, but I'm not going to get chopped out. So when we're looking at everything going on, and we understand Bitcoin does not stand alone by itself. In fact, altcoins also are kind of garnered by this risk approach. If Bitcoin's falling, altcoins, especially in an uncertain market, are going to fall further. Understanding that the global liquidity, the rate of change, and also the actual global liquidity, when this is down, Bitcoin is down. It's not why is Bitcoin crashing. These things are all tied in together. Now, we got a guest that's coming on here in just a moment. I see him waiting there in the wings. Let me assign him. Guest number one. We actually met in Singapore. He's been in the markets for some time, and he knows so much about these markets. In fact, many of you might have graduated high school before this gentleman was born, but this guy is super smart. I can't wait to see where he goes in the future. That is Mr. Crypto Kid. How you doing, good sir?
Thank you so much for the incredible introduction, man. I'm doing well. Actually, not too good. The past week has been not the nicest on a market, especially if you're all into crypto. It's not the best, but you know what? I think we're holding up pretty well in relative to traditional finance. So can't complain. Can't complain.
I mean, I completely agree with that. I was just sharing this chart here, which shows Bitcoin relative to the SPX. And as I was pointing out, this moving up doesn't mean Bitcoin price is going up. This means Bitcoin is holding up currently better than the stock market. The question is going to be, and I think a lot of people have this question, is that drop in the S&P 500, is that drop in the stock market going to be a leading indicator for a bigger drop in Bitcoin? Or are we kind of at that point where we're reaching max capitulation and we start to find a bottom? And I was kind of highlighting Kevin Svensson is the one that put me onto this quite a while ago, that it's not necessarily the correlation of what's going on in the markets. It has mostly to do with especially risk assets, but just investments in general. Is there certainty about what's going on or uncertainty? And so the question is all this uncertainty already priced in with these massive drops, and we'll start to get, sort of a normalcy. And when we start seeing people come to the negotiation table regarding tariffs, different countries and such, or even if they don't, does that certainty start to get priced in and the markets can rebound? How are you feeling about this? Because you're in Dubai. Is that correct?
Correct. Yeah, I'm in Dubai. I mean, it's good because we were kind of isolated from all the economic and political tensions that go around across the world. So I'm pretty grateful to be here. But in terms of, is the current tariff situation certain or uncertain with expectations and what's going to happen in the future? I think it's definitely filled with uncertainty. I mean, Fed Chair Powell said it himself that I think that there's just pure uncertainty on what's going to happen, and that's why when you go to the University of Michigan sentiment report, the consumers are extremely concerned, and I think they have the right to be, because the main point of concern is actually the rise of inflation. Obviously, tariffs are inflationary. There's been so many people that have said that tariffs are non-inflationary. That's completely false. Inflation is low right now. President Trump said over on Truth Social that Chair Powell should be reducing rates because jobs are up and inflation is down and interest rates are down and eggs are down. So he should be cutting rates. But obviously now, if you do all these tariffs to all these countries, which I'm not saying is a wrong thing to do. I think it's a good thing to do. America first approach. I personally think it makes sense. But when you look at the market in the short term, they are going to be inflationary, and inflation is a lagging indicator. So the actual data that we get from prices going up, that will be reflected on the CPI report within 6 to 9 months. So obviously, if that's going to be the case, they can't just drop rates. They may even keep rates at a higher point for longer because of that potential rise in inflation. And then American companies, people are greedy. Corporations are greedy. They're going to say, you know what, because of the tariffs, we're just going to slap on an extra 5% to the price, because why not? We can just blame it on the tariffs. We can just blame it on the administration. So I think that's what's going to happen. I think prices of goods and services are definitely going to increase massively. And manufacturing of goods within America, within a domestic approach, that's going to take time. You have tons of trillions of dollars coming in for foreign direct investment, but to turn that capital into actual manufacturing and actual jobs will take a very long amount of time. And that's why I think short term there's going to be a lot of pain, potentially even to the end of this year, or maybe maybe until Q4 of this year. And then 2026 and beyond could be better for risk on assets. But I think Bitcoin is holding up very well. And I do have a chart, Kelly, to share if you don't mind.
Yeah,
It's
pull it
about the
up.
global liquidity. Let me share my screen very quickly. There we go.
Oh, hold on. You're gonna have to drop off and reconnect.
Okay.
You have what browser are you using?
Yeah,
There's something on there with the audio. Drop off and reconnect, and then reshare.
Okay, gotcha.
Yeah. Always have these issues with the technology. I never thought getting into crypto we'd have to become audio visual specialists. But to his point, there he goes. He's coming right back on. There we go.
All right, let's try.
Oh, same thing. Talk. Yeah, it's a robot voice. I'm trying to think what we can do. Can you take a couple screenshots of a few charts and I'll pull and DM them to me? I'll pull them up on that way. Yeah, and you'd have to drop off and come right back on. So we're going to get those charts up, everybody. It's always issues with different browsers, different connectivity here. But, talking about realistically, what he's talking about might sound scary, but remember that may be great opportunity in the market. If we are so bullish, let me say this. If we're so bullish on this market and we end up having a super painful year, the pain is only because we're expecting it to go up now. If we're bullish on where this market is going over the next 5 or 8 years, and we have a choppy year and we don't have this complete parabolic run this year, maybe all the way into Q4 or maybe early 2026, that means we have that much more time to figure out how much money we can raise, how much fiat we can mine to get better and better positioned if we do get chopped throughout the rest of this year. I'm still of the opinion that maybe I'm a blind bull. We're going to have a reversal on some of this and see some very likely see some major upside, but I'm okay. In fact, I secretly want this market to be super choppy through this year, maybe even drop further, maybe like we saw in 2019 with the large sort of intermediary bear market that those that were stacking there saw the ultimate gains into the bull market top of 2021 into 2022. So coming back over, we got our guy back on. So did you DM me some charts?
Mm-hmm.
All right, cool.
Yes, sir.
There we go. Pull that up. There we go. So here we go.
So yeah, Kelly, I think I'm honestly not entirely sure. It's just that there is a lot of uncertainty, and recession could happen, and we can have the same sort of consolidation that happened between March and November. And like you said, it would be a very selfish ask for us to do that and desire that, because it would allow us to buy more Bitcoin, build more products, and so on and so forth. But I just have a very strong feeling because of how strong this correlation between global liquidity and Bitcoin was, arguably since Bitcoin's inception. I think that with this 109-day delay over on global liquidity put on top onto the price of Bitcoin, I think it's very possible that we get a chop for the next 34 days between the range of 76 to the lower 80s, and start of May, coinciding with President Trump and the Trump administration adding Bitcoin onto their balance sheet. I think that is when we can see an increase back into the 100K region, and then eventually into new all-time highs, because as you can see, global liquidity, that has been hitting all-time high after all-time high. And also, tariffs don't directly impact Bitcoin. Bitcoin is not producing goods and services in other countries and importing and exporting. So tariffs as economic policy has no impact on Bitcoin whatsoever. And that's why I think after a month chop, we should be able to see.
Say that one more time. Say what you just said about tariffs and Bitcoin.
Okay, so I mean, if you look at Bitcoin, right? Bitcoin is a product. It's a monetary product. It's technology, but it doesn't produce any sort of actual real world good or service that is imported or exported to and from a country. So tariffs itself don't really have a direct impact into Bitcoin. Whereas when you go to the S&P, it's filled with countries, having their production overseas, and they import their goods to America, so on and so forth. So obviously, companies within the S&P 500 do get a direct impact from tariffs, and that's why they dump more. So, you look at Nike, they have 500,000 employees in Vietnam. Vietnam just got slapped a tariff. So obviously they're going to trade lower than what Bitcoin would, because it's a direct impact onto Nike stock. So I think Bitcoin is not going to see a major impact here. I think we're going to hold on pretty well. And then that's why within the next month, I do expect us to continue going up.
You know, on that point, Standard Chartered, I pointed this out earlier. Standard Chartered just said also Bitcoin might pump, and this is near term, to 88K this weekend. But I'd be more interested on beyond this. But this is because this statement, as it has become the U.S. isolation hedge. So I think this is the starting of that flippening that everybody was talking about, Bitcoin and ETH flipping. That's the flippening. No, man, the flippening that's most important is when people start to realize that Bitcoin is not a risk asset. It's going to be probably many years until we get there. We're going to see it in different instances in different ways, like we're seeing right now with tariffs, Bitcoin holding up better than the S&P 500. However, those people that are stacking into this risk right now that are not blindly following the FUD out there, and oh my God, it's showing like a tech stock, it's going to drop. When I see dips, I say, my greedy self goes, God damn it, I want these green candles. But my smart self goes, holy moly, why am I? Let's be grateful. We have more opportunity, more time. We see the biggest tailwinds in history coming across the board. It's not just the US. Abu Dhabi stacking Bitcoin into their sovereign wealth fund. We see El Salvador only getting stronger with their Bitcoin strategy and policy. Bhutan is mining Bitcoin. 100 different laws are getting passed here in the US across state level. Legislators in favor of Bitcoin. We have a strategic Bitcoin reserve act that's we already have the executive order, but the actual buying pressure that will come for that. MicroStrategy is only increasing how much they're buying. We're seeing other companies, and people are bearish. What the fuck? What the fuck? I mean, you know.
Yeah, 100%. And I actually did post a tweet. I completely agree with everything you said. And I was just trying to find that to give you the exact data because I think there is a real flipping happening like what you're saying. In the past 24 hours, the S&P is down 4%, gold is down 2%, oil is down 9%, but Bitcoin is actually down 0.05%. Sorry, 0.5%, and Dogecoin up 8%. So I think there's a clear flipping happening. The S&P is back down to where it was during the Japanese yen carry trade in August of 24. And now you can see that the S&P is back down to where it was in August of 24, but Bitcoin is up 66% respectively. So I completely agree. I think Bitcoin is diverging away from being a risk on asset. And I think hedge funds and institutions today are realizing that, hold on a second, maybe we should diversify into this Bitcoin thing because when stocks are down, Bitcoin is up. And yeah, that's I think that's pretty bullish.
Well, I gotta pick your brain on also before we go. Of course, Bitcoin is the star of the show as it should be, but there's a lot of people that are probably, I don't want to say over allocated, but are very heavily allocated in the altcoin market, wondering when this alt season is going to come. So 3 questions on that. Are we going to have alt seasons like we've had before, or is Bitcoin going to be, you know, that rotation isn't the same as before because there's so much institutional capital behind Bitcoin?
I think we're going to have an altcoin season. It's just that when you look at 2021, when we had the last altcoin season, the amount of savings per capita in the US specifically was at an all-time high. The amount of debt was at an all-time low. Now you fast forward 4 years into the future, debt is at an all-time high. The amount of mortgage delinquencies are just surpassed a new, massive all-time high. So it's like, it's not looking good for the average Joe. Inflation is high. I know that the S&P 500 since 2023 was looking like there was a huge bull market, but the truth is it's all artificial and it's an illusion. The average Joe in America and around the world, they're suffering, especially in countries apart from America too. Obviously, again, the UAE is a bit of an isolation, but I think a lot of countries and a lot of people are struggling. So people don't have money to go ahead and invest into altcoins. The reason why Pump.Fun and meme coins became very popular is because when people have low money in their pockets, when they have only $10, $20 to go ahead and invest into something, they put it into meme coins. They put it into gambling. They put it into lottery tickets. That is what's been happening for the beginning of mankind in different sort of ways. So the reason why meme coins pump was because people don't have money in their pockets. But eventually, we're going to get that economic stimuli. I think quantitative easing will likely happen beginning the end of this year and start of next year. So I think it's going to take longer than originally anticipated, even by myself. But I think in the next 10 to 11, 12 months or so, we should be getting that altcoin season.
Yeah, I agree with that. I think we're going to see some scattershot like we have seen over the last, I mean, March last year, we had that sort of mini alt season top. It's like a little baby alt season, full round trip. And then there was another sort of somewhat focused niche season with the AI, and then very strong with the AI agents that completely melted back down. I do think that as we move forward, I agree. Once we really start getting money printing back out, and if there's Elon Musk and Donald Trump have talked about potential refunds back to people, but regarding Doge and some of the savings there. But I just can't really imagine, unless they do it as a political sort of gimmick, unfortunately to say that, to sort of buy votes. You know what I mean? I don't really see the US with having $37 trillion in debt, giving money back, like putting money back out there. So I wouldn't count on that. But I do think that as corporations, venture capitalists, and all these, there's a completely different viewpoint that's starting to emerge, I think, because of all the tailwinds that are coming behind Bitcoin and the crypto ecosystem now with this new administration, with the foot getting taken off the neck of the industry, that we may start seeing some very focused capital in certain sectors of the market, and the DePIN sector, the decentralized infrastructure in AI and some AI adjacent areas, layer ones. But do I think it's going to be like, I mean, I don't know if you were there last cycle. So I've been here 3 cycles now, and it's ICO craze. Everything ran. The altcoin cycle last time, almost pretty much everything ran. This cycle, I don't know if we're going to get that same concerted, everything's going to go. But I do think we're going to be seeing popcorn around the space. As I've posted, I think I posted and talked about 2 months ago, I think crypto easy mode is over. And now we're still going to see better gains and better security and better financial sovereignty opportunities in crypto now than we can in traditional markets. However, I don't think it's just throw money at the market and you're just going to be making money hand over fist. I think you've got to take a little bit more concerted approach as to what, where, and why money is going to be flowing into this market. What would you say about that before we wrap out?
Yeah, I would agree. I mean, I still think at these current prices, if you buy in, everything will pump. That's my personal thought, because I mean, we're just altcoins specifically, they're down to 2023 levels. So I personally think that in a given, not even a altcoin season, but just in Bitcoin's price going back to all-time highs, I think that if you do buy these prices, you should be making some sort of profit. But are you going to make 100x on an ICO, or are you going to is the same sort of situation going to happen? Honestly, I'm not sure. Maybe not. But I think the safest bet to be doing right now at this moment is to be building some sort of a business in crypto or in Bitcoin, having a Bitcoin treasury company, doing some sort of an agency in blockchain, or I don't know, going into some sort of business working in crypto. I think that is the next advantage, because if you're building products, if you're building services, if you're helping institutions onboard onto blockchain, and all that sort of stuff, I think that will see major demand. And if you are there as a builder, as a business owner that has been in crypto, knows how blockchain works, can help institutions onboard onto blockchain, I think that could be a very good approach to capitalize on. But honestly, no idea. I just know that these prices are very cheap all across the board. And if you hold for at least 6 months, you should be in profits.
I love it. I actually said yesterday, I did a post about it, that if you're following anybody that's sure right now, unfollow them, because even the best economists, smartest people I know in the space there's so many different signals because of the lingering effects from the global economic shutdown, the mass money printing, the logistics supply chain issues. And then now we have a new administration changing the paradigm that's really shaking things up. There aren't really, as Michael Saylor says, he talked about when 10 billionaires or 100 billionaires all buy, it's going to break all your models, where everything we've seen geopolitically and geoeconomically over the last 6 years has broken all the models. All I know is I know there's going to be money printing. That's a guaranteed function of fiat currency. And I want to be in capital capture mechanisms. And the best one out there is Bitcoin. And if the rails of the future are built on blockchain, then altcoins definitely have a place there. I'm not a Bitcoin maxi, but you should be heavily allocated in Bitcoin and find your focused areas that you think that this future is going to be built on. Well, Crypto Kid, I appreciate you coming on. I just want to shout out for everybody. Make sure you
Thank
go
you so
give
much,
him a
man. Thank
follow
you.
here at CryptoKidCom. right there. And I'll drop the link. Oops. I'll drop the link in the live chat right here. If you're watching on X, you can just go right over there. You should be able to see this in the live chat as well. He's also one of the co-hosts, over on Carl the Moon on their show. And I'm looking forward to seeing you and hanging out with you again when I'm in Singapore for Token 2049. You'll be there, right?
Yeah, for sure. I mean, Singapore, not 100% sure,
Oh,
but
sorry,
I'll be in Vegas.
I didn't mean Singapore. I meant Dubai.
Yeah, we're here, man. So, I mean, when you're here, I'd love to have you on the Moon Show, and we can have you here in the studio and definitely hang out. So thank you so much for your very kind words, man. Thank you so much for having me on your show. Thank you guys for watching. And with that said, I'll leave you to it.
Oh, dude, I appreciate it. It was cool. Somehow, I think it was an accident for both of us, but somehow both of us ended up on stage, talking with the real Donald Trump Jr. and Eric Trump and the hut mining and all that. So it was cool that we get some questions. Again, I appreciate you. I love seeing people in the space doing great things, and you have more wisdom in you than many 72-year-olds I know. So keep it up, keep going. Everybody, make sure you go and follow him.
Thanks, brother. Thank you. Take care, man. Bye-bye.
You too, brother. Everybody else, I appreciate you all being here. Thank you all so much. We're going to got to throw you over to the blockchain basement. What a great conversation there with Crypto Kid. Make sure you're giving him a follow. I'm going to make sure the redirect set is set here for blockchain basement. There we go. Now, everybody, I hope you all have an absolutely wonderful day. I really do appreciate you. Hit the like button, hit that subscribe button, ding the bell. And it's a weekend. Enjoy yourself this weekend. If you're frustrated, there's other things in this market, in this world than just the markets. Take advantage of buying the dips or take advantage of the time away. I love you guys. That's all I got. Adios.